When buying a home, how much money do you need to bring in, and where does all that money go? Today on Mortgage Deep Dive, we discuss cash to close when buying a home. Cash to close, also known as funds to close, refers to the total amount of money you want to budget to bring in when buying a home. Now, a couple of quick disclaimers. Number one, the content of this video runs the assumption that you are obtaining a mortgage in connection with your home purchase. If you are paying all cash for your home, this information will not apply to you. Number two, there are escrow states and there are attorney states. I am based in California, which is an escrow state. This information is consistent with escrow states. And then number three, I am recording this video in the fourth quarter of 2022. I say that because mortgage programs and logistics are constantly changing. By the time you watch this video, there may be revised information. Please keep that in mind. Now, before we dive in, I'd like to properly introduce myself. My name is Jason Gordon. I'm a residential mortgage specialist. You can call or text me at 619-200-8031. You can email me at jasongordonmortgage@gmail.com. You can access my electronic business card at vipborrower.com. Now, a couple of legal disclaimers I am required to give you to stay in compliance. This information is for educational purposes only. There is no legal or tax advice being provided. Nothing about today's presentation shall be construed as an offer to lend or a specific rate quote. Therefore, any examples are just examples. I am an equal housing lender and my NMLS ID is 259027. Cash to close consists of three parts. Part one is your down payment. Part two are your non-recurring closing costs. And part three are your recurring costs. Let's take a closer look at each one. Let's begin with the down payment. Now, whether you are budgeting a percentage of your sales price or a set dollar amount, the down payment, quite simply, is the difference between your purchase price and your loan amount. This is the easiest of the three to budget ahead of time. Number two are the non-recurring closing costs. Now, the word recurring means ongoing. Therefore, non-recurring means not ongoing, or perhaps a bit better grammar, we'll call these one-time costs. Now, non-recurring closing costs consist of two subcategories, which are the lender origination fees and the third-party fees. Lender origination fees can vary between lenders, and most lenders have many different origination fee combinations available depending on what interest rate you choose. The rule of thumb is that the higher your rate, the lower your origination fee. This is when lenders can sometimes give a negative origination fee and provide credits to some, if not all, of your costs. Now, the flip side of that are that lower interest rates equal higher origination fees. Sometimes you'll see these referred to as discount points. The bottom line is the more you pay in fee, the less you pay in rate, and vice versa. The second subcategory are third-party fees. Now, these are separate companies. I always say these are separate cooks in the kitchen who are doing a job who want to get paid at the end for what they've done. They have a different logo on their business card than the lender does. Examples of different third-party vendors include, but are not limited to, the escrow company, the title insurance, the appraiser, the county recorder, the notary. Now, what's important for you to know is that lenders cannot and will not mark up any third-party fees. There are checks and balances in place to protect you, the consumer, to make sure that those fees are never inflated. However, when you ask a lender up front what their total costs are, we lenders don't know which third-party vendors are going to be assigned. For example, when we get a copy of your purchase contract that says that you are now in escrow, we not only identify the sales price, the property address, the duration of time your escrow period is going to be, but also your purchase contract identifies who the title and escrow companies are. You see, those vendors are typically chosen by buyer, seller, and or the real estate agents involved. So therefore, we lenders discover who we're working with once you're in escrow. And therefore, we then discover what those third-party fees are. So please keep in mind that third-party fees and even the lender origination fees are not known at the time of application. We do discover those as we move forward. Now, category 3 are called recurring cost. This name sounds very similar to category 2, which are non-recurring closing costs. Category 3, the recurring costs, are not fees to acquire the mortgage loan. Please make sure you are able to identify and separate the non-recurring closing cost from the recurring cost if and when you are shopping lenders. If you mesh them all together, then with all due respect, you are not making an informed decision. Again, category 3 are recurring costs, which are not fees to acquire the mortgage loan, and instead they are different amounts of other costs that are being collected as part of your cash to close. Let's take a closer look at some examples of these specific recurring costs. Now, the first example of what are collected among these recurring costs are what we call homeowners insurance, also known as hazard insurance. While lenders do not write the policy or specify which insurance company you have to use, please be aware that lenders do require that you pay your full insurance policy in advance for 1 full year. Now, a lot goes into this dollar amount. Which insurance company are you using? Is the property a condominium or a single-family residence? Are you in a fire and or flood zone? What are your deductibles? Do you have a multi-policy discount within your auto insurance grouped in with your homeowner's insurance? So suffice to say, a lot of variables go into the dollar amount of this annual policy that you will pay in advance for 1 year. Another reason why it's very important not to include this when you are shopping for a mortgage company, because the mortgage company doesn't know what this will be up front. Again, they discover these variables as they go along. Now, as someone who has helped thousands of home buyers throughout my career, I warn you, this next section is typically the hardest to understand, especially if you are a first-time home buyer. This section here runs the assumption that you have an impound account, also known as an escrow account. In other words, when you make your monthly mortgage payment, are you including 1/12 of your annual property taxes and homeowners insurance into your monthly payment? If so, you do have what's called an impound account. Now, this is not the official word, but think of an impound account as a slush fund. And in this section here, under recurring cost as part of your total cash to close, this is an opening deposit into your slush fund. Now, how much are we collecting as part of this opening deposit? Believe it or not, the amount that we collect is dependent on what month of the year you close escrow. So take a look at this colorful screenshot. And on the yellow side here on the left, we have each month of the year. You want to find the month that you close escrow in order to determine how many months of your annual property taxes we are collecting as part of this opening deposit into your slush fund. So as an example, let's say we close escrow in March. If you go across to the pinkish category here, we would collect 2 months of your taxes. What if you close in September? We collect 8 months. Now, again, these are not charges. You're not being charged a certain amount of months. We are calibrating your opening deposit into your slush fund consistent with the property tax calendar, which I'll go over in just a moment. But let's just say, for example, you're paying $6,000 a year in property taxes. That's $500 a month. If we're collecting 2 months over here, that's $1,000. But if we're collecting 8 months, that's $4,000. You can see how these amounts can vary considerably. And once again, this is not what you want to shop lenders with, because in the end, it's all depending on when you close escrow. So if you were pre-approved for a mortgage in January and they estimated you close in February and collect 2 months, but you don't close until September and we have to collect 8 months, you can't hold the lender accountable for their original estimate, because that's all it was an estimate. If you close in a certain month, you will have this many months collected as your opening deposit. Now, why did we have these kind of weird numbers in this pinkish category? It all pertains to the property tax calendar. Now, this property tax calendar takes some getting used to. If you think about it, there are 12 months in the year. Property taxes are due twice a year. A logical assessment would be that property taxes should be due every 6 months. Well, that's not the case. If you look at these green rectangles here, you'll see the actual property tax calendar. Taxes are due on November 1st and on February the 1st. Now you have a time window to make those payments. In this case, the first installment due date each year is on November 1st, but you have until December 10th to make that payment to avoid late fees. Now, a late fee here is 10% of what you owe. And there's no negotiating this late fee. There's no waiving the late fee. You must pay it if you're late. So go back to the previous example. If you're paying $6,000 a year in property taxes, you're billed twice a year. You have 2 different bills each year for $3,000. If you paid this bill after December 10th, 10% of $3,000 is a $300 late fee. Ouch. The good news here is that if you have an impound account, it is the lender or servicer's responsibility to make those payments on your behalf. And should there be a late payment, they pay the late fee, not you. Now let's go back to the calendar though, because why would we collect all of these kind of weird amounts of months in the pink category? It all depends on when we close escrow, as we saw here in the yellow category, because if you think about it, if we were to deplete the entire balance in your slush fund on November 1st, we would not have 6 full months to replenish the account before the February 1st payment due date. So therefore, the reason we have this kind of bizarre amount of months here in the pink category is because we have to calibrate the amount of your slush fund properly so that there's always enough money in it throughout the year for that lender or servicer to reach in and make that payment on your behalf for the property tax due date. So that was a lot to unpack, and you can see why that is a very confusing part of the cash to close for home buyers, especially first-time home buyers. Let's go to the last category here, which is what we call per diem interest. Per diem is Latin for per day. The best way to describe this section here is that lenders are very good at math, and lenders leave nothing on the table in terms of money due. So here's where you have to kind of trick your brain, especially if you are a first-time home buyer. Let's say, for example, that we close escrow in March. As you see here in the green section, your first payment is due on May 1st. When you are paying rent and you pay your landlord on May 1st, you get to sleep in the building during the month of May. This is how we are all taught to think. However, when you have a mortgage and your mortgage payment is due on May 1st, that May 1st mortgage payment is paying the interest due for the month of April, the previous month. It's called paying interest in arrears or from behind. So this section here of the per diem or per day interest is where the lenders kind of level up and get their money that's due. So let's say, for example, that you close escrow on March the 30th. You pay your first payment on May 1st. That covered all of April, but there's still a couple days between March the 30th and March 31st that must be collected. Now, in that case, it's not that much money. It's only a couple of days of interest. But what if you close escrow on March the 4th? Now we have about 4 weeks of interest between March the 4th and March 31st that has to be collected. So this section right here, again, is estimated by the lenders up front, but they don't know up front when you're closing escrow until they get the purchase contract. So this is a number that can be maybe a couple $100 or a couple $1,000, depending on your loan size, the interest rate, and the day of the month that you close escrow. And last but not least, there may be some prorations that are calculated if indeed the seller has paid in advance for property taxes, HOA dues, and maybe other types of assessments. Just know that the escrow officer will work in harmony with the lender to make sure that these numbers balance to the penny. So with all that in mind, this is an example of what goes into your cash to close. Let's say, for example, that your total cash to close was $100,000. And let's just say, as an example, not a quote, but an example, that of that $100,000, $93,000 was your down payment. The other $7,000 consisted of the non-recurring closing cost and the recurring cost. Technically, the non-recurring closing cost and the recurring cost are eligible to be paid by others. They can be credited, most commonly by the lender and or the seller. Now, if the lender is crediting these costs, it's not for free. It's because you're taking a higher than market interest rate. And of course, if the seller is paying these costs, depending on the market itself, if you're asking the seller to pay these costs on your behalf, that may be weakening your offer in the eyes of the seller if there are other buyers trying to buy their property. But regardless of the variables involved, the non-recurring closing costs and the recurring costs are eligible to be credited. So in this example, if we have $100,000 of cash to close, $93,000 of it was the down payment. The remaining $7,000 consists of the non-recurring and recurring costs. Your credit could not be more than $7,000. So if you negotiated, let's say, an $8,000 credit, you cannot use that extra $1,000 because that extra $1,000 would be infringing on your down payment. Now, there are some creative ways we can use that $1,000. Maybe we add that to the origination fee and lower your interest rate. But just know that the total amount of creditable numbers are solely the non-recurring closing cost and the recurring cost. Now, one last example here is that if you have $100,000 in cash to close, it is customary in most markets to have what's called an earnest money deposit. We call it an EMD or a good faith deposit. Same thing, just multiple names, where you make a deposit as part of your offer. and that money is then applied towards the remaining cash to close. So what does that mean? If you have $100,000 of total cash to close, and let's just say, for example, your earnest money deposit was $10,000, that money would be applied towards the $100,000 that's owed. Therefore, at the end of your escrow period, you would bring in the remaining $90,000 to close escrow. Now, there are many different rules and different dynamics that go in with the earnest money deposit, which I'm not going to go into now. Just know that your deposit is truly a deposit towards the remaining amount due. So $100,000 due, $10,000 deposit. The remaining $90,000 is due at closing in order for you to take ownership of that property. So as you can see, a lot of information goes into the total cash to close. If you have any questions, please feel free to reach out to me. My contact information is over here on the right-hand side. I'm Jason Gordon, residential mortgage specialist, and I truly appreciate your time today.